Is China truly uninvestable? After high hopes of a recovery at the start of this year, with GDP numbers beating analyst estimates in the West, the economy is slowly starting to fall into another economic slowdown. Investors in the West specifically, as well as domestic mainland folks, are not finding confidence in investing in their own economy after seeing signs from the government at the latest plenum not aligning with their values. Chinese equities have lost a total of $7 trillion in value since the peak in 2021, but at one time, Goldman Sachs, like the rest of Wall Street, was actually in love with Chinese stocks. Let's be honest, folks, for decades, Wall Street fundamentally misunderstood China. Ever since Alibaba, for example, went public on the Nasdaq in 2014, the country looked modern with its technologically advanced stock markets, and many investors in the West were truly mesmerized by the business strategies. However, in most recent times, the Chinese regime, by driving the force behind Jack Ma's exit of Alibaba and strictly regulating those companies, has cast doubt on the soundness of China's equity markets. A really important question is still being asked in markets worldwide as to whether or not there is a recovery trade still in China. Because as anybody familiar with markets can tell you, there is no direct correlation with what the economy is doing and how markets behave. It is simply led by investor sentiment and expectations of what is to come for earnings. Despite the slowdown we've seen in the property sector, which has been the main headline in the West, the economy of China is still growing faster than most other emerging markets. GDP expectation growths are still at 5% for 2024, and the country still leads when it comes to solar module manufacturing, EVs, batteries, the supply chain of electronics, as well as software automation. What this means is that although right now there are tensions, there is a huge growth story in the private sector. And although EPS have fallen a lot over the past 3 years, they are starting to be revised to the upside so far in 2024. EPS, or earnings per share, is what determines the fundamental value of any stock or investment you're making. And right now, the fact is China is much cheaper than the United States, with a trailing PE of almost $10, whereas the US is trading at north of 25. Yeah, sure, there's obviously risk in China, which is why it's trading cheap. But the extent to which it is trading cheap is the real opportunity right now. The correlation between Chinese tech stocks and US ones has never been this bad in modern history. And as we're all familiar, no trend lasts forever in markets. Although Xi Jinping and his government didn't give a very thought out plan of how they expect to lift their economy out of this current slowdown, there are glimmers of hope, especially with the upcoming Politburo meeting and the election in November. What China is facing right now, folks, is deflation, the exact opposite of what's happening in the West. Xi Jinping's regulatory crackdowns on tech giants and the sweeping tax audits have created, obviously, an apprehension in the private sector, which has also caused a property slump and hence causing lower consumer spending. However, what Chinese leadership did indeed mention at the latest plenum is their goal of actively expanding domestic demand to lower interest rates and fiscal policy, and obviously improving their high-level socialist market economy. In other words, markets have a place in China, particularly in the private sector, as long as they serve the party's grander goals of national security. And well, what exactly are the goals? They revolve around domestic demand, quality of life, a booming property sector, and keeping productivity as high as possible. And as far as we know right now, productivity in China is primarily led by the technology sector. And it's that same technology sector which has seen the markets collapse since 2021. Alibaba, for example, which is China's Amazon, is now trading lower than it was at the IPO price in the United States almost 10 years ago. Yet their revenue is now more than quadrupled since then, with cash flow of almost $20 billion annually. As a matter of fact, something like Alibaba stock is trading at a multiple of more like an oil stock rather than an AI technology software retail company. Comparing it to Meta, Google, Microsoft, Amazon, Taiwan, as well as Nvidia, we're seeing a clear picture of just how much disparity there is in valuations. This isn't a question at this point of whether or not China is investable. At this point, it's much more about whether these values make any sense in the short term. Because even if there is a geopolitical risk, there shouldn't be this much of a difference between these two types of sectors. At this point, it's not a recovery trade, it's a valuation trade. And although Trump getting elected could be another headwind for the economy of China, it isn't going to be as big of a deal as it is right now, as it was 5 years ago when Trump was still president. Companies are diversified their revenues significantly. Even companies like Alibaba have diversified their business to not only selling in China, but also selling software solutions and cloud products abroad. And guess what? These aren't going to be services that are going to be tariffed because they're not hardware. Chip companies in China certainly can struggle, and even EV companies to a very small extent could. But right now, China has the voting power when it comes to the manufacturing of these products. And if they were to come abroad, they would obviously be destroying the competition. And so tariffs under a new presidency will not affect the recovery of the economy as well as investor sentiment to a big extent. Instead, it's going to hurt local producers that have not diversified their business, manufacturing, and supply chain. The good news is, though, folks, that EPS estimates are rising and valuations are still rock bottom. Cash flow and profits for Alibaba and those companies dismayed in 2021 are starting to go up. And services are recovering much better than actual property and goods, which we expect to be actually driving the recovery forward. But as usual, folks, that is just my take on the situation, so let me know your thoughts down in the comments section below. Thanks a lot for watching, and I'll catch you guys in the next one. Take care.